Do you know how the stock market works? What is the stock market and how does your cash get converted into shares of stock? In this video, I'll show you the weird birth of Wall Street along with how it really works when you buy or sell shares. We're talking everything stock market today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending part of your day here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. We talk about investing in the stock market a lot on the channel, but do you really know what that means? What happens when you click buy on your favorite investing site, and who are the people handling your money? How does your cash get converted into those beautiful shares of the Joseph Hogue Corporation? Oh, so beautiful. I've worked in the industry for nearly 2 decades, first as a venture capital analyst and an investment analyst, then for private wealth clients, and what I've seen of the stock market will shock you. In this video, I'll show you some of the crazy stock market history, the weird birth of Wall Street, as well as how today's stock market really works. Now, I'm mostly going to talk about the US stock market here because, well, I'm an asshole American that thinks the world revolves around me. I'm okay with that, and honestly, most stock markets work about the same way. Now, the first stock market was in Amsterdam in the early 1600s. Europeans were binging on spice from India, but it was hugely expensive to compete, which meant sending dozens of ships, building ports, and generally just fighting pirates. The result was the United East India Company, or the Verenigde Nederlandische, the VOC for short. The company was set up to sell shares that would pay a dividend but would be dissolved after 21 years, and then investors could sell their shares after 10 years. The company was so successful, though, that they decided after 10 years that it wouldn't be dissolved, so investors needed some way to buy in or sell out of their shares. That created the need for a formal place to exchange information and to sell the stocks. Fast forward to about 50 years, and it's the Dutch again that created Wall Street in America. Except it's not the Wall Street you're thinking of. After the wars with England, Dutch settlers in Manhattan, then called New Amsterdam, built a wooden wall along the southern tip of the island. The wall stood 9 feet tall and went 2,300 feet from the corner of Wall and Pearl to what's now Broad and Wall Street. That wall was taken down in 1699, but nearly 100 years later, stock traders started grouping daily to trade under the buttonwood tree at the corner of Wall Street. Anyone that wasn't a formal member of the group that wanted to buy or sell shares had to work through a broker, and that's how the stock market was born. Now let's look at how today's stock market works, how it works when you buy and sell stocks, the players involved, and some of those myths about investing. First though, a fun little pop quiz here. Which do you think is the most heavily traded asset class in the world? So between stocks, bonds, currencies, gold, and commodities, which do you think has the highest trading volume each day? Put your answer in the comments below, and I'll update the first comment in a week with the answer. So now the stock market can mean different things. It can mean that physical or electronic exchange, the location where stocks are traded, like we'll talk about now. A stock market can also mean, though, the idea of the stocks in the market. So here we're talking about those indexes, sectors, and other ways to group stocks. Let's first look at how the stock exchange works, and then we'll talk about that other idea, the idea of the market. Now, the stock market is like an auction house where there's no set price for stocks until buyers and sellers find one. Companies issue ownership through shares in an initial public offering, or an IPO, where the public investors get their first real chance to buy in. Now, an important fact here about buying and selling stocks is that after the IPO, that first time that the company airs shares on the market, after that, the company takes no part in these shares. It doesn't make any money on these shares again. This is why the stock market is called a secondary market, where buyers and sellers can trade their investments. Now, other than when a company buys its shares back or when it rarely issues more shares, it has nothing to do with any of this buying and selling and makes no money from it. Now, buying stocks gives you an actual ownership of the company, and most shares have voting rights for the company in shareholder meetings. The problem here is that even a few 100,000 shares may only be a fractional percentage of the company, so most investors aren't really going to control much of the decision making. For example, at a market value of over $1 trillion, you need to own $10 billion in shares of Apple to control just 1% of the voting rights. Now, besides the New York Stock Exchange on Wall Street, there are other exchanges like the Philadelphia Stock Exchange, the Chicago Mercantile Exchange, where they trade commodities like oil, corn, gold, and then the NASDAQ, which is a wholly computerized exchange. Now, on these exchanges, all stocks have a bid price, the price buyers are willing to pay, and an ask price, which is the price sellers are willing to accept. Now, a transaction only occurs when one of these prices meets the other or when someone places a market order. That's when you tell that investing platform to buy you shares at the current ask price or to sell your shares at the current bid price. But what actually happens when you click that button to buy or sell your shares? What's the process and how does this actually work? Now, honestly, most exchanges run electronically anymore, but there are still some physical exchanges in open outcry. In the good old days, your order would go through a broker. Okay, these are licensed and regulated dealers with membership on the stock exchange. Now the broker would receive your order along with all the other orders from its investors and then send that message down to their floor traders to buy or sell the shares. The floor trader would then go to the place on the exchange where that particular stock is traded and would transact the order. Now, this brings us to probably one of the least understood players in the market, but one that's absolutely critical to good market functioning. Now, market makers are the employees of large banks or investment firms that are contractually obligated to buy or sell a specific stock. Now, this person has a spot on the exchange that is designated for that stock and where all the traders know that they can go to buy or sell it. The market maker has an obligation to buy or sell the shares if there's no one else that wants to take that other side. For example, if a trader comes up and wants to sell 100 shares of Microsoft, the market maker has to buy those shares if there's no other traders there to buy. Now, of course, the market maker sets their price depending on other orders as well as the supply and demand for that stock. They set a fair bid in the ask price from their own book, the bank's ownership in that stock, and then adjust it up or down depending on the news. All this makes absolutely sure that there's always trading available in a stock. Without market makers, and especially in times of big news or uncertainty, there might not be anyone there that wants to take that other side of your buy or sell order. Market makers help keep stocks trading even in the face of that big price-changing news. So that's how the market works. But when most people talk about the stock market, they're thinking about that idea of the market. They're talking about an index like the S&P 500, which is just a group of the 500 largest publicly traded companies in the United States, a group that is supposed to represent the entire market of shares. Another index is the NASDAQ listing of mostly tech and biotech stocks, which is also an electronic exchange. Click on the video to the right for what I call the biggest investing lie since Bernie Madoff, the price to earnings ratio. Why is this the worst investing rule you can follow and why the media wants you to use it? Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.